Hi, everybody. Welcome to the webinar. Can some folks maybe in the chat let us know if you can hear us? We'd love to hear from you, hear about where you are, that sort of thing. We're really excited to do this webinar with you today. All right, you can hear us. Thank you, April. So pleasure to have you. I'm sure some people are going to come in over the next minute or two, but we'd like to get started. As you can see, this is our Revenue Manager Roundtable. You might hear me accidentally call it a Revenue Manager Fireside, but we went with Roundtable. I got a bunch of great revenue managers here, and this is going to be part of our recurring series that we do monthly, where we bring revenue managers in and just have a conversation about what's going on. We found that when we go to conferences, we have a lot of friends, we get to meet up and chat, and there's, whether it's in a session or just in the vendor hall, people are always around and kind of listening to what we're having a conversation about. And even if you're not in the same market or in the same area or have different properties, there's always things that you can take away that are valuable, whether it's how you look at data, how you think about your own markets, what people are expecting to happen and how they might plan for it. And we hope to give you guys kind of a forum to be able to hear that. So why don't we start with a few introductions? Can maybe we go around and we'll give everyone just a couple sentences on who you are. My name's John DeRelay. I'm with Wheelhouse. Have been a revenue manager for about 10 years, formerly with a company called Stay Alfred, and really look forward to being able to work with folks and help with their revenue management. And maybe Rebecca, do you want to give us a start off after me?
Yeah, hi, I'm Rebecca. I'm with Revenue Research. We are a consulting side for revenue management and for operations. So we have about 30 clients all across the United States and Hawaii as well. So we're in a lot of different markets. Previous to this, I was a revenue manager for a large company in Gulf Shores and Orange Beach, Alabama. Managed about 400 listings, 400 units there. So got a lot of years of revenue management.
Awesome. And if anyone else wants to jump in.
Yeah, sure. Like John, I also came from Stay Alfred, bounced around a couple departments there, and then I have landed at Sextant Stays, and we currently operate out of New Orleans and the greater Miami area.
Perfect.
I'll go. I'm Sarah Franzen. I am with Natural Retreats. We are a property manager with several locations across the U.S. And I've been with Natural Retreats for a little over 7.5 years or so. Came from hotels before that in sales and revenue, and love vacation rentals so much. I just stayed.
All right. Hello, I'm Tom Lyons. I'm with Casago. We have about 35 destinations and close to 3,000 properties altogether. Plus 20 years of experience in revenue management, was with Hilton on their executive board. Just jumped into the vacation rental industry about 3.5 years ago. So it's been great.
Awesome. Well, thank you guys. You may have seen Andrew pop in. He's actually not speaking right now. Do you want me to remove your co-host permissions, Andrew?
Yeah, I thought I was in the audience. My bad.
Awesome. Well, really a pleasure to have you guys all here. This is a great group of revenue managers, folks that I talk to a lot on a personal basis and have also gotten to know professionally. So it's really exciting. We're going to have a kind of an informal conversation. The goal is just to kind of talk about what's going on and kind of have that interchange. So why don't we start out with just a question that'll kind of like help us get going. But I asked everyone to think about maybe a situation that they've been either dealing with or thinking about in one of their markets specifically, and we can kind of share those and go from there. Whoever would like to start, otherwise I'll call on you guys.
I'll start, guys. I'll start. All right. Yeah. So I think we're all in the climate right now is challenging. So we're really looking at different booking windows real closely right now. The 30-day booking window, less than 30 days, we're seeing a lot of shrinkage in that window. where we're really starting to believe that that 60 to 90 day is prime real estate for how we revenue price and look at demand really closely, and try to still share from our competitors when it comes to that 60, 90 day booking window. We realize that with the shrinkage of the 30-day booking window, how do we gain more share? Yeah, there's a little risk to that, but knowing the climate of the different locations and understanding where they're at based on, less bookings going 30 days, having to drop rate a little bit more in 30 days, maybe going empty. It's better to start being a little more aggressive in that 60 to 90 days, which really has helped us shift share in our way. So it's been real challenging in a lot of ways, but it's been really helpful for us.
Tom, is that something you're doing? So just so everyone knows, almost everyone here is a multi-market operator. Is that something you're seeing consistently across the board?
Not all across the board. It just depends on the location. So you have to take every location differently, and that's the one thing we have to look at really. A lot of us on this call have several locations. So when you see USA reports and occupancy and supply, you have to take that down to a granular level of your location. We're seeing so many differences in supply and demand based on location. So you have to really dive into the location first, understand what's going on in that market, truly understand what's going on so you can better price. And that's where we come up with this 60, 90 day. We see our competitors or self-renters really not, really being static a lot of times in rate when it comes to that 60, 90, 120 days. And then they start dropping when it comes to 30, 40 days out. We believe with the state of the economy, plus the shrinkage of the 30-day window, we believe we can gain share in that 60, 90 day is really helping us still gain share year over year and gain growth year over year.
Yeah.
Awesome. If anyone else would like to jump in and either respond or bring up their own kind of observations off the bat, that'd be great. Thank you, Tom.
Yeah, no, I think I agree with a large portion of that. It's certainly what we're looking at in Miami. There, depending on which sources you're looking at, supply is either up or really, really up. So and it looks like the market in general for Miami is a little bit more uncertain in terms of what kind of compression and what kind of price people are going to be willing to accept. So at Sextant, we've been kind of retooling our Miami portfolio to try and expand that booking window because what's the old adage? The best time to plant a tree was 20 years ago, and the next best time is right now. So yeah, we really don't want to get stuck holding the bag with a lot of empty inventory. Conversely, in New Orleans, where we generally know that January is kind of a rough time, we took time to plan probably mid-November, maybe a little bit earlier, but we had a whole script on what we wanted to do for pricing for New Orleans in January, and it was more or less a play for occupancy because we've got to also compete against a lot of hotels that aren't operating at peak occupancy, and they can oftentimes offer a lot more in terms of actual services. So that was a long-term plan that we laid down, and I think it paid off. We got the occupancy that we were generally looking for, and we came out quite a bit ahead of where we were last year for the same time when we look at what we did for January.
Yeah, I agree with that. I think honestly for us in every market, it's getting back to the basics. I think that for so long we've really blessed with a really high demand, and we could push ADR really high, and we got lucky. And as revenue managers, our jobs were still tough, but right now it's kind of like we're back in elementary school. We're learning, going back to the foundations of revenue management, parts of my brain that I haven't had to use in a few years are kind of going, oh yeah, that's what we need to do. See someone asking what ADR is. I'm sorry, I should have said average daily rate. So your nightly rates. So looking at portfolios and really taking that data and really looking, no matter if you have 20 properties or 500, looking at where you're at currently and then looking a season ahead. Because I really do think that the key to 2023 is going to be being proactive. Just like Shane was saying, is we can't fall asleep. Like the demand is not going to, that wave is not going to push us through to the next season, where we're going to have data and logic behind the rates that we're putting out there. And I think that that's getting back to those fundamental things, no matter what market you're in. If it's urban and you have booking windows, or your beach market and you're having families book farther out, you have to know your portfolio and have it segmented in a way that you can easily be moving forward as time is going, so that you don't miss those prime time where you can push rate because you're outside of the booking window. So it's definitely, it's fun. I mean, we're back to doing what we love to do. I think it's just going to be challenging for people who haven't had to do revenue management outside of COVID. It's a different ballgame.
Awesome. Thank you.
Yeah. The one thing I was going to add, I mean, all of that is fantastic. I don't dispute any of it, and especially because we are all in different markets. So you're seeing different things in different markets that are oftentimes very incongruent, like opposite almost. Maybe not opposite, but very different. And, one of the things that Shane mentioned about New Orleans, which is something that I think about quite a bit in certain markets of ours, is when you are in a market that is heavily saturated with hotels or, when there's a lot of different types of lodging units, it's not just your own portfolio and it's not just market demand in general. You really need to what Rebecca was saying, segment down and figure out what is actually driving certain things. So, it is, in some ways it's like easy to, say, oh, let's pick a market and go with something. But at the same time, with all of us who are spread across other ones, we're seeing so many different things that it's often difficult to just say, okay, like pick one specific example, because for every one example you have, there's something that's, basically giving you a very different view. So it's hard to pick one.
Totally. I have heard a few kind of consistent things, particularly from like Tom, Shane, Rebecca, and Sarah. Really, all of us have kind of mentioned something about concerns in the short term in certain markets, and then really thinking forward and planning for that quarter ahead. I can tell you a little bit about what I've observed working with clients, and also I work directly with a few portfolios. And there's been a few very specific trends that have been interesting to me. The first one is my experience at Stay Alfred. We had a lot of southern markets that had a Q1 high season that were not ski markets. Ski markets are a little different, right? And usually the booking window like shortens up a lot over the holidays. Like you have a few good holidays, but it's otherwise slow season. And then it'll jump back out, right, as people start to book for spring and summer. And this year, to me, on kind of a subjective sense, it feels late. It feels like that jump it really didn't start until the very end of January, and it hasn't jumped out that far. So I look at some of these markets that I would expect to have a bunch to be consistently selling for February and March right now, and to have been doing that for a couple of weeks. And I just am only selling a few weeks into February, right? Yeah. That is a concern for me, right? Another one is in some markets, this is more of an observation of the Wheelhouse model, and it's not true everywhere, but I have seen a trend where the recommendations for like next week are half or more than half less than 2 weeks from now. And what that's indicating to me is it actually looks very similar to, I've seen this a lot in California, actually. It looks to me a lot like how rates looked at the end of the summer in the South last year, where people had held rate expecting things to just grow, and then it kind of fell off a cliff, and then rates collapsed.
Wow.
Yeah. And those two trends are an indicator for me that kind of fit into what you guys are saying, which is I tell this to people. It's like, it's always easier to explain to an owner that you left a little money on the table than why they have vacancy.
Oh, yeah.
So
Yeah, it's John, you know, ADR, you know, average daily rate is just so important. So when you start dropping rate, it's an issue because you're trying to still grow year over year revenue for that owner. And every time you're dropping rate, if you're dropping it below last year, how are you going to gain revenue year over year? So you got to be real cautious of when to drop rate, understand when you can get rate and try to get it at a maximum, knowing on other dates, you might be dropping more than last year, you know, 10, 15, 20%, but then try to gain it on your holiday season or other seasons to try to get revenue growth year over year.
Kind of an interesting question I have for you guys is, because you guys have all been in different situations over the last year. How do you deal with trying to grow overall revenue year over year if you're concerned that things are maybe down? Like, I mean, I'm sure some people maybe think of that as impossible, but I don't know that that's the case. I know some people succeeded last year when other people didn't.
Yeah, I think.
Oh, sorry.
Sorry.
Go ahead, Shane.
Okay, thanks. I think in a lot of ways, kind of the last year and a half, maybe 2 years, were some real banner years for a lot of markets. And, you know, now it's kind of looking like there's a lot more uncertainty, at least some of it's obviously consumer driven, and then whatever kind of what we're expecting out of the markets. But so there's a lot more uncertainty, and, you know, kind of with the general observation that some markets are really like that kind of 30-day window really dropped down to pretty short stuff. It really is just kind of making the adjustments to be like, okay, I think I need to be more comfortable with maybe taking more reservations further out than I would generally expect for this market, and maybe at a little bit lower rate than I would expect for 45, 60, 90 days. And then, you know, if you build up enough of an occupancy base, if you've got the inventory for it, then maybe you pick your threshold and say like, okay, at this point, I want to raise the rate because now I've things are segmented so much that I really only have to worry about maybe a couple people picking up something at a higher rate. And then, you know, if you did your math right, you end up maybe improving or matching what we did last year. But I think that's probably the best way that I know how to either mitigate or improve upon last year.
So what I was going to say is I do my best to not worry about what I did last year. And I know that that's hard because we have a business to make happy and we have owners to make happy. But if my focus is capturing share at a reasonable market rate, then I'm doing my job. And I think to the earlier points about, you know, the shrinking windows and whatnot, I mean, that is a strategy shift that I think we've probably all, it sounds like, had to make, which is, you know, you're going to have to be aggressive and make hay when you can, when you're going to see that demand is still holding strong in certain points. But when it's not, you're going to need to flip the levers and you're going to need to kind of pull out the stops for what you're going to need to do to capture that share, which again, you're seeing softened demand in certain times when over the last couple of years, maybe it wasn't so much so. So I think if we're doing all of those things, you know, I guess that's optimizing your revenue, right? You know, we're not trying to optimize a rate. We're trying to optimize the full revenue for these homes. And again, I mean, we're not talking hotels or, you know, where there's a single owner. You're talking a bunch of individual owners that all have varying goals and you know, their concept of success might be different than yours. So obviously there are different variables in play here, but I really try to keep my focus on capturing share and doing it at in a reasonable way.
And we're really starting to see a lot of price resistance. And the sign of you're seeing price resistance is that you see the booked rate of properties in a certain market. You see the book rate, and the book rate is so much less than the unbooked rate properties, and that's a really big sign of a lot of price resistance going on. So that's a trigger to understand, you know, you're only going to get so many shots of getting that customer, and you want to make it at the best price possible for them. So you really have to be engaged in understanding, you know, your price resistance, understanding, you know, how many views you're getting on properties, understanding how many calls you're getting, and then how many are regrets or denials. You got to really be engaged right now to understand when to drop. And again, it goes back to ADR. None of us want to drop ADR. I mean, it's the easiest way to get there in revenue. But as the times are coming, you got to try to drop it at the right price for that right customer. So you don't want to drop it too much, so it's buy down, but you're really watching that price resistance closely and trying to get that, you know, that price that's right for that customer.
Yeah, I totally agree with all of that. And I think if I was in the audience today and I was listening to this and I go, okay, well, how do I know that? Like, what are my markers? And for us, one of the biggest thing is to have realistic expectations of those properties, so that whether you want to call it budget, you want to call it projection, you sales schedule, whatever verbiage you use, to have those monthly goals so that you have your, you know, historic projected occupancy there. And what is your goal broken down by month? I do it by seasonality, to know when you're looking at your calendar and you're going, okay, well, weekends, you know, for urban markets are where we make our bread and butter. But like, how do I win occupancy Monday, Tuesday, Wednesday? Well, if all I got to do is hit 2 weekends, I hit my budget. Okay, I can pull rate down Monday, Tuesday, Wednesday. So practically, like, that's what we're kind of talking about when we're talking about strategy, and how we implement that. Because that's not just an urban strategy. I mean, that's very much a beach strategy. You know, the weekends are when people want to come. You can use your length of stay, like all of those things practically is what is going to make you stand out in 2023, because you're competing with a lot of other people that may not be making those adjustments ahead of time.
I'm kind of curious, because I agree with you guys in really focusing on this like later window. This could go two ways. One is digging. Can we dig a little deeper into those mechanics? Like, how do you judge what you're resetting or what you're changing, right? It's like, we know that we set rates maybe based on some forecast of growth. Now we're like, hey, it's soft now. How are we reviewing that? Maybe we have an example. Another way we could kind of take this is, you know, a lot of the time, I think to get to the, like, telling people how we get to this conclusion, it's like, we're looking at stuff going on now, and we're actually extrapolating forward enough to say that we think it's more important to focus later than now. That's an interesting thing, I think, for people to maybe hear as they're thinking about their own revenue management.
I guess I speak for you. So we look at a term we use, it's probability factors, okay? And so it's an equation where we say, okay, if we drop down to X price, what's the probability factor percent of that property getting booked? So we take that in consideration and say, okay, if we drop down to X, the probability factor is 60% chance it's going to get booked based on the demand, the supply, the forecast, the current occupancy for that destination. And then we come up with probability factors. Now, and then it goes back to some owners, okay? And I think all of us here would agree that owners will complain more about occupancy than rate. So then you got to look at, okay, as this owner wants us to be aggressive, then let's be aggressive and understanding now the probability factor of getting booked is 80% chance it's going to get booked. So we take that equation into effect when we're looking at this pricing overall.
Shane, were you going to say something as well?
Yeah. So like in my situation, I've been looking at kind of what we expected in the last year and a half, or where we kind of set our nominal rate, or what that nominal rate plan was. And then, looking at it now, it's with maybe balancing a little bit more uncertainty than we're typically used to. It's reviewing like, all right, is this nominal plan working right now? And in a lot of cases right now, it's not. So this was an exercise that I've been working through the last couple of weeks, particularly in Miami. It was like, okay, we have this rate. It worked spectacularly well last year. I mean, worked really well. It's not working right quite the same way right now. So on a couple of the properties that we have, I kind of ran some tests like, all right, what happens when I make, most of it was reductions, a couple were increases, but if I make these reductions at like these points out further out where I would expect to see reservations coming in, is that effective? And I kind of set, John will appreciate this, I set some heuristics on what I expected this test to result in, and then came back to it after maybe a week and like was checking to see that, is this measuring up to what I thought it was going to do, what was expected. And I kind of let that drive, where it's like, okay, well, there were maybe a little bit more reservations coming in than there was before. Maybe that's seasonality and booking window. Maybe that is directly price related. So, and then I just kind of let that drive based on where that is actually going. So I found in a couple of cases that like, yeah, the nominal rate plan we had set up for Q1 was a little bit too aggressive, a little bit too much, and it really just kind of needed to come down. And in some cases, it wasn't a lot. I think one of the better results I've had, I basically ended up reducing 5% across the board, and I saw a booking window increase almost immediately. It was just kind of like, oh, it was that much of a change. Like, and sometimes that's all that price resistance is like, yeah, it was 5%. Okay. Like,
that's a really interesting point, I think, is we used to talk with other revenue managers that I worked with. We used to call it like chasing the curve. And that's like one of the worst situations you can be in, which is also why I think that you guys have all said here that you've noticed these resistances. So you're focusing into a deeper booking window, because it's really hard to chase the demand curve in the short term, because you don't actually have time to figure out where the customer is willing to pay, and they're changing much more rapidly in the short term. So when you start focusing on a further window, you can get more out of your work, basically. But the most difficult aspect of chasing the curve is basically, it's like how many people are willing to pay at each different price point. That's changing every day. And if you don't have any data points, it's really hard to find that curve. That means you have to guess. So one of the worst situations you can be in is to have an empty calendar and not know at all where people are willing to pay. How have you guys been like evaluating that, either in the short term or for that kind of longer period that you're looking out?
I think for me, it's kind of taking a surgical approach at a lot of portfolios. It's because you have those outliers, you have those units that are pacing ahead, and we've already pushed rate. And so we can push rate some more there, but then really focus on the bottom side of those units, the bottom side of the portfolio. Like, they need the most work. And whatever it may be looking at your distribution strategy. Are your calendars synced right? Is all of those other things that aren't just rate related, like on your marketing side, when's the last time you've done an email blast to these group of people? Like there's also those other avenues that you kind of tap into. But I think when you're looking at, just say you're seeing a lag in spring break, you're down 5%. This was an example that we just had with a client. And it was looking at her units by each one where it was pacing. And she had 10%, the 10% of her units were pacing 20% higher, but she had, this other group that were new, had no historics. They were already struggling, were pulling it down. So it looked like they were behind, but actually they just needed some realistic rates in there. And needed some kind of help to go, okay, from a marketing standpoint, how do we get these ones pushed up a little bit? How do we get them in the river to, on OTAs, get some bites there, or direct booking? So I think it's not being afraid to look at it unit by unit. I know that seems overwhelming, and with 3,000 listings, like, it is overwhelming, but you can find the problems really easy. And then you can also push those units that are doing really well, make them do great. So I mean, that's what we're kind of focusing on.
Yeah,
I was just, oh, sorry. I was just going to echo that. I was just going to echo that in terms of segmentation. I think that's really huge for us, because I think, to Rebecca's point, if you're not revenue managing on a home level, you're doing a service to the owner, right? You have to look at it on a portfolio level, because otherwise you're missing the whole forest picture. So you have to really approach it in both ways. And I think that the segmentation is a way for at least how we're looking at things. So if you can take a market look and see how you're doing, if you have, the more segmentation you have, the better the easier it is to kind of find that needle in the haystack kind of image. But, I think that's really important. And I think, when you set a strategy, for some time in the future, you're setting, it's a strategy, right? It's a general plan. And then you're obviously having to make tactical shifts. And you set that strategy based on a few assumptions. And so as you go, you're testing, okay, are my assumptions right? So hopefully you're not doing too much strategy shifting, you're doing more tactical shifting, because hopefully your assumptions are pretty solid. But I think that when it comes to kind of testing that out, kind of what Shane was talking about, a lot of that for us comes down to segmentation and how we're measuring ourselves.
I agree. I think you really got to dive in, and I'm going to sound redundant here, but the supply, we all know that supply grew in 2022, 25%, while occupancy grew around 21%. So supply is outweighing demand. Now, the good news is that we only anticipate supply going up 9% for 2023, which is great. But what you really have to do then is we talk about segmentation, really breaking it down by bedroom type, by characteristics, just your really, if you need to do a SWOT analysis, et cetera, but really understanding what the supply is coming to your market, what is the growth. For example, in Phoenix market alone, supply went from 4,000 properties up to 7,500 properties in a year. That's a lot of new supply. So it's not, the realistic is demand is not going to outweigh supply in that market. Now, then you have to really break it down by the supply coming in and how many are 1 bedroom, 2 bedroom, 3 bedroom, 4 bedrooms, and really gain understanding of, with this new supply, how much is, 1 bedroom, 2, 3, 4. Now, every market is different. If there's no new supply in for 4 bedroom or X, your likelihood of what Rebecca was saying, you might not fill it. You might not fill it at all. You might be able to push rate. Now, if all that new supply is 2 bedroom, you're going to fill it because there's just all this new supply. And then there's a lot of self-renters that are pricing, that are not revenue managed trained, and they're pricing at all different price points. So you really have to really dive into your segmentation of your bedrooms, your unit level, and get granular.
Yeah, it's kind of like, I think too, drawing it back to those, like Shane kind of referred to it as a nominal rate, or like whatever you had assumed last year. People kind of, forecasting is really hard, and you work with a lot of teams who aren't revenue managers, and a lot of the time it's like, okay, well, we're going to try to get 10% growth, right? You kind of want to coordinate that back. You're like, hey, if I know supply is outpacing demand in these room types in the future, but I have set my rate 20% above last year. That's easily identifying for you an area that you might need to adjust, because if you don't look at it early enough, it's going to hit you really hard. You're going to be like, oh, we're 20% higher than the market. And now I know that relative to supply, demand is down. We're in a problem where if you can deal with that now for the later windows, you will walk into that situation, not necessarily be concerned. You might actually do the opposite behavior. You might be actually, we can still raise rates because we might even be able to push above the market because we have so much less to sell, right?
Yeah.
Awesome. Well, we have about 10 minutes left. I was thinking that maybe if anyone wants to say another thing for folks, that'd be good. And maybe we could hit a couple of these questions. There's been a lot. And I can maybe just read a few off, and we can, anyone who wants to jump in can. How does that sound?
Great.
Perfect. So let me scroll up here. People were asking quite a bit of questions. Zafar asked kind of a general question about the occupancy for December and January year over year. He said Marriott wasn't expecting rates to drop, but it says we're anticipating a decline in demand. I think for us, maybe discussing why we think there's a decline in demand, either through our own data or, you know, what we're reading. Tom, you mentioned the supply aspect is a big portion as well.
Well, I think demand, let's talk demand. I think, pre-pandemic numbers, and then, everybody in 2022, just because of COVID and everything, I mean, the demand was so high, so we reached record-breaking numbers. So, and demand based on the economy, inflation, even, with supply, with interest rates going up, you have less demand because of not as many people are traveling as they were right after, COVID. So everybody was traveling. You had a lot of people working from home that would do 30, 60-day stays that were, I think it was, 40-something% of the workforce was working from home at one time. So everybody was traveling and staying those longer stays. Now, now that has dipped and they're, people are back at work, et cetera, it's harder to keep up with that demand. And that's why we're seeing less demand. Also, hotels, we've seen hotel growth. Now, hotels are growing at a higher occupancy rate on demand than vacation rentals. When the economy was so great, we had a tendency to raise fees on housekeeping, damage waivers, booking price, booking rate, so there was all these fees, and we were starting to, really, the fees were so high. So now hotels are taking some of that share back they lost. And it's about 11% share they've taken back because they don't have as many fees. And it's our goal is to how do we get that share back from hotels? And then also, how do we look for that demand that is not there from 2022?
Yeah. It's one thing I think to remind people about too, when we compare our data to hotels is generally speaking, vacation rentals, they're in what hotels would call the transient business segmentation. It's people who go on and purchase product on like online or directly. That is the most fickle of the segmentations, right? It's the least able to forecast ahead. It's the one that changes the fastest. And that's where we mostly live. So when you talk about a Marriott, Marriott's almost like they're a closed sales network in addition to being a hotel brand. They're like, it's like saying booking.com would be like, well, demand really isn't down for them, but it may be for individual suppliers, right?
Sure. Absolutely.
Okay, let's pick
the one thing too, I was just going to piggyback on that, John, like with the hotel thing, and that's, I think communication within our own companies, but something that needs to get out, which isn't necessarily a revenue manager putting this out there into the ether, but if you're going to compare a hotel and a vacation rental just on rate, I mean, that's a problem. So, the education piece needs to be, how are we differentiated? And that differentiation is not just a rate thing. So that goes beyond revenue. But I think, it's easy to want to just, hotels, come stay with us because we're cheaper, or I'm going to go stay at this hotel because it's cheaper. And well, is that really why you stay at a hotel? Do you want or at a vacation rental because it's the same price? Like, I don't think so. So I think there's a bigger narrative there.
Absolutely. I think we got maybe time for one more. This one I think would be pretty interesting because it does relate to what we've been talking about looking forward into the next quarter, some slowness this quarter. We've been talking a lot about rate, but Miles asks, how does length of stay restrictions play into the overall revenue management strategy? I think more specifically for us, has that been something you've also been adjusting? And how have you been looking at restrictions in general in relation to your rate strategy as you're reevaluating the next quarter?
I think length of stay is a huge lever, huge in terms of it really can tie your hands behind your back, especially when you kind of get into the beach markets. This is something that they've been doing vacation rentals for a very long time. That's Saturday to Saturday, 7 nights. That's what they have. However, you need to know your guests. Your guests may not have 7 nights to stay. Guests may put more value on, I'll pay more if I can only stay 5 nights. We've seen that over and over again. And that's tough because you have owners that have expectations of they think that they're going to get less wear and tear if they have a family, but really, do you want someone in there for 7 nights? Because they're going to be cooking every night. Like, have 3 nights, they're going to have a beach night, they're going to go out to eat, they're probably not going to touch your kitchen. So your wear and tear may be less on the shorter stays than the longer, but it's walking the owners through those communications to allow you to have that. But I do think that length of stay makes it's a huge thing where you can leverage rate, you can get higher rate for a shorter amount of stays. And I think in the urban, you are kind of competing with those shorter stays. So don't make them stay 5 nights. They're not coming to stay 5 nights or 4 nights. They're coming for 2. Like, I think it's a really big, that can really cripple you really quickly if you're not kind of staying on top of that.
Yeah, if you don't have to flip your rate lever, the length of stay one is great. And I mean, and that's the other thing is, you have several, levers available to you at any moment. You don't have to flip all of them, and length of stay is one, and it's one that can move the needle. So, I think it's a huge one, and one that, to Rebecca's point, a lot of owners are resistant to because of the way things have always been. But people are not behaving the way they've always behaved. They're very different. We've had a shift in consumers and how they behave. So, we have to either reflect that and respond to that in our with our homes, or potentially get left behind.
And the data is out there to be able to share that with homeowners. It's out there to show them, you can make more money with shorter stays, and this is what the market is doing. So don't be afraid to kind of push that forward, to be able to support. It's not just what Rebecca feels. This is what the market is responding to.
Interestingly, too, if you have ways of, like, if you have a large enough portfolio to aggregate your own data, I do this a lot because I come from multifamily where we didn't have to deal with owners the same way. So we looked at bricks of units, but what you can do is say, show your future occupancy in the units where you do have looser restrictions and compare them. So you're not giving up individual information, but compare them to the groups of listings that don't. And sometimes that case is really easily made. It's like, look, you're trailing behind the rest of the units in my portfolio, and I'm pretty sure it's these restrictions because we have similar rate strategies. This is the main difference, and you're X below, right? Same in that vein, I will often, as part of my segmentation, look at performance. So if I look back at my last 30-day, 90-day, year performance, if you're concerned about your booking pace in the future and you don't know whether it's just the market changing or your price too high, I almost always test that to get data points in the stuff that performed bad last year. If it performed bad last year and it's not performing well this year, you have nothing to lose by dropping that rate X% to see if people buy that. And then you can extrapolate it to your most important properties. You can say, okay, well, if I have the rate 5 or 10 or 15% lower, I know I can sell. Do I want to now do that with these other units, or do I want to make the decision to hold them back? How much risk am I willing to take? Awesome. Well, we are at time. Does anyone want to say something before we go? I'll open the floor for us on the presenter table, not on the audience.
Thanks
All
for
right.
having us.
Yeah.
Absolutely. Really appreciate you guys giving us the time to chat. I hope this has been valuable for everyone. We will send out a recording for this and post it on the Wheelhouse YouTube on a playlist. We plan to do this every month with various revenue managers in this space. If you are a revenue manager and you would like to participate, please reach out to me and I'll put you on the list. And we hope to just continue to have these like detailed conversations about what's going on so that everyone's kind of on the same page. You know, this is something that's common in hotels. Their revenue managers talk to each other. If we can do that in our space, it kind of builds the mentality that it's not necessarily you against the property management company down the street. It's actually all of us against the market, because the market is what's changing more often.
Yeah.
All right. Thank you so much, guys.
Thanks for having us, John.
Thanks.
Have a good one.
Bye.
Bye.